Yes.
Can I substitute the words basis for 300,000 and still come up with the same answer if there was a 1031 exchange into that property?
Yes.
Thank you.
Yes. His question related to a 1031 exchange, so I won't elaborate on that one, and if we want to talk further, we'll do that offline. That'll get into a different area. Those were the good days, right? When 1031 exchanges were in effect. Now those I love to do, and everybody was happy when they came in and looked at doing a 1031 exchange. But I have had clients, and the anxiety related to this foreclosure and modifications, short sales, is tremendous. I've had clients come into my office, and you can see the notable stress in their lives related to this. As they talk to the lenders and as they try to talk through doing what they're doing, they get scared. The lenders are telling them, you're going to get a 1099-C and you're going to, this is going to be income to you. And they're terrified. They're looking at these numbers and they're saying $100,000 of income. They do a quick Google search. They go out and they find out, oh, I'm in the 25% tax bracket, $100,000. That means I'm going to owe $25,000 in taxes. So when they, in consultations, I've had them where they'll come and they'll sit down and they're almost fidgety there at my desk, you know, and explaining the fact pattern and talking about what happened. And it is so rewarding to be able to walk through the transaction with them and to be able to find where they might be helped and to see them leave your office and to have a notable feeling of calm that comes over them and saying, okay, this is something, it's not a great thing that's happened to me, but it's not as bad as what I thought it was going to be. And that's a great thing for you to be able to help your clients with. And that's what these provisions are in place to do. Things have happened in a bad way in our economy and in the market for people that, you know, on the time frame that they bought. And so these things are put in place to help the people that need it. Chances are, if your client needs help, they're going to have it here. If they're not insolvent and they make a lot of money, then, you know, they're not going to meet these things, but they may have the ability to get out of it. Does that make sense?
Can you go back to that slide for a second?
Let's see.
At the end there, it says
Yeah.
taxable income is a $50,000 loss to the client. Is that right?
That is right. So in the two scenarios that we gave, in both situations, and we'll do that one more time. The rental property, they bought it for $300,000. They put $50,000 down. They owe $250,000 on it. On the rental property, it sells, and and we treat the foreclosure amount as the sales price. It sells for $200,000. They have a loss on their tax return of $100,000 related to the disposition of a rental property. And then they also have a cancellation of debt income of $50,000. So again, the net difference between the rental property loss and the cancellation of debt income is a $50,000 loss.
And is that an income or capital?
That one is an income. But again, this is a good transaction because even though they picked up $50,000 of income in the year, they also got a $100,000 loss that they get to write off in that year.
That reduces their taxable income by $50,000.
Yes. Yes. For an investment property, that we go through that same fact pattern. In an investment property, they bought it for $300,000. The bank takes it back for $200,000, or they bought it for $300,000. They put $50,000 down, and then the bank takes it back for $200,000. What was the loss that they had on the property? $300,000, $200,000. They have a $100,000 loss. If it's an investment, not rental property, that's a capital loss. And so they get to use that up in the future. But they report the $50,000 taxable income in the year that the debt is canceled.
That's the one they can only write off for $3,000 a year.
That's right. That's right. Now, but what we want to know is, in that situation, can we help them in these other areas to get it excluded, right? So we're going to start to ask them, you know, questions about solvency, bankruptcy. We're going to start going through those questions to say, is there something else we can do to help them? Okay. So, if you're meeting with a new client, for you to be able to get an idea about their situation, and you know that they're dealing with a foreclosure, a short sale, a modification, what is it that you're going to ask them? Number one, primary residence. So you're going to say, in me, I make it very general so I can get to the answer. I say, what type of property are we dealing with? That's question number one. Okay? Depending on that answer, that'll let us know where we're going to go with our next question. If the client answers your question and says it's a primary residence, then what's your next question? Did you take cash out, and what was it used for? Okay, from there, you're going to be able to know what you need to do next. If they did take cash out and they used it on cars, boats, RVs, what's the next area of the code that we might be able to help them with? We want to find out if they're insolvent. And that's going to lead us into the bankruptcy area. Let's take a step back now. If we get back to it and we say the client doesn't tell us it was a primary residence, they say this was an investment property. And then you want to know what type. Was it a rental property or was it just an investment property? Again, we still want to know the golden question. Did they take cash out? And what was it used for? Yes?
Does it make any difference whether it's residential or commercial rental?
The question is, does it make a difference of whether it's a residential or a commercial rental? And it doesn't make a difference. This kind of goes back to another question that was asked earlier. When you get into commercial rentals, sometimes they don't hold the property the same way. The LLC corporation question that we had back here, that would be a question in the commercial area. We'd make sure how they, how that was being held, what type of taxable entity it was held in. Yes?
And there's no difference in the tax consequences or laws between foreclosure or short sale?
As far as the tax law,
consequences.
as far as the tax consequences go, no.
Okay.
No.
When you ask the question, did you cash out, if the answer is, yes, I did, but we put in a pool to improve the home, that's different than, yes, I bought an RV.
That's right. The question is if you ask the question, I took cash out, and they answer yes, there's a difference if they took the money and put it back into the home, or if they took the money and went and bought the toys. Yes?
On that question, I know a situation where they consider that like a second, and the second is not accepting, they're not working well with it. They think they still owe that, but I would think that they wouldn't owe on that because it went towards the house.
Okay, so the question is if there's a second mortgage, the mortgage holder isn't working with them on the modification of the loan, and that's a different issue outside of the tax realm. So I won't address that specific.
It is a short sale.
Okay.
But because that pool
Okay.
was pulled out of the house.
So her question was, okay, so the question that she posed then is, there's a first mortgage, there's a second mortgage. The second mortgage was used to do a pool, and in that case, the lender is basically telling them we're going to pursue you personally on that. In that case, the debt hasn't been canceled yet. And so there's we've taken this. We're here at the end, so I'll address this one a little bit further. But in those situations, we're trying to take a close look at the fact pattern, and even in consultation with the attorney, to see if we can basically say that the facts have gone into play that the debt's been canceled. Like, at what point has the debt been canceled? And again, we'll try to report it in a year, even if they don't get a 1099-C, and then we'll do the steps necessary to let the IRS know what year we reported that transaction in. Yes.
When does the property have to be a primary residence?
The question is, when does the property have to be a primary residence? And I'll give you a fact pattern that I had recently, and maybe that'll help us to understand the question. But we have clients that come in and they had a home and things went upside down and they needed to walk away from the home. They walked away from the home and then they moved into another home. At the time that the debt was canceled, it was their primary residence. So we've taken the position that it qualifies for the Mortgage Relief Act, because at the time that the debt was canceled, that's what they were claiming as their primary residence. Yes?
What about if people cash out to make their mortgage payment to start a business?
The question is, what if people take cash out of their home to make their mortgage payment or to start a business? And in that case, in a logical way, you may say they took these payments and they went right back into the house. I think that the fact pattern there is not going to help you. It's going to count as cash out. So it needs to be, for us to be able to go to the IRS if we get challenged and to be able to stand with confidence, we want to be able to have invoices and things that show the improvements to the home. And in that case, we won't be able to show that. Yes?
Yeah, sorry, this kind of goes back to the last question, but is it still true that you have to have lived in a home for 2 of the past 5 years? That when you sell it, it's considered?
The question is do you have to live in the home 2 out of the last 5 years for it to qualify for your primary residence? And the answer to that, under the Mortgage Relief Act, that's not part of the Mortgage Relief Act. So what you're looking at is the area of the tax code that says it qualifies for the primary residence exclusion for the gain on it.
Right.
So that fact pattern is different than what we're covering here.
Okay, so that's true. If I'm just selling a house, it's not a short sale,
Mm-hmm.
then I can be excluded from capital gains because I had lived in it 2 of the past 5 years.
It depends. It depends, right? You like that answer from the CPA.
For a short sale, that's not considered at all.
That's not part of the short sale. Don't you love it when you talk to your CPA and you call them and you say, it's a quick question, and then you get the answer, it depends, right? It's because the fact pattern that you're giving is leading to more questions. And so in this case, as she asks the question about two years for the primary residence, I want to start to ask questions about how long did they live there, how many years have they lived there, was it ever a rental property, et cetera, to get to some other sets that will help answer that question. But we can talk more offline on that question. Yes?
It seems to go back to that question, when does it become a primary residence? So say I own a second home, I'm about to lose it. I move into it, I realize, hey, I'm losing this home, I'm letting it go. But I want it to be my primary residence and not an investment property. So I move up there this month and then I let it foreclose.
Yeah. With that type of fact pattern, because we get this type of question often, and people are trying to skirt around the tax code. So they find that part of the tax code that says, okay, we can do it, then they try to make their situation fit the pattern. And I'm not discouraging that, but there are pitfalls in doing that. So when that happens, you run the risk of them going back and looking at what was it when it was originally purchased, how were you treating it, those types of questions. So you run risk in that area.
So, but still the question remains, is there some sort of fact pattern that allows you to call it a primary residence?
There isn't. In this case, as CPAs, we call these a bright line test. You're just telling me, tell me what the test is, I'll meet it. I'll meet it. You tell me and I'll meet it. And again, on that one, if somebody were calling me on that one, I'd give them a big, it depends. It would really, yeah, that one would be a big one. Yes?
Okay, if you have a client who buys a home from you, he already has a home. He buys the new one, closes, and then turns around and short sells the first home.
Mm-hmm.
That first home still qualifies for the Forgiveness Act?
If that was his primary residence when he moved out of it, I would take the position that yes, it was. Yes?
Is there any other type of 1099 that would be issued other than a 1099-C?
Great question. The question is there any other type of 1099 that would be issued other than a 1099-C? You have a 1099-A. The 1099-A is given, I'm trying to think of the title on the 1099-A. It's basically notifying you that the bank has taken the property back, and it gives you some of the facts that you need here. It lets you know what the bank sold the property for. So it helps us to complete a lot of the information that we need for the tax return. So the 1099-A that they send out is just informative. It just lets you know what the bank has done, that the bank took it back under foreclosure, the amount that the bank sold it for, the amount of the debt that was forgiven or relinquished, or maybe not even forgiven or relinquished,